Okay, good morning. Monday, the 14th of February 2022. We've got invasion potential is creeping higher and higher in the Ukraine right now. It really seems that the US is pushing this line and it's certainly bleeding into and getting priced into these markets. So we went live on YouTube just a little bit earlier in the middle of it. VIX is looking very, very punchy for the week ahead and spells more downside really for equity. So we're down on the DAX 1.8 at market, SPOOS 0.86, and Dow zero point 0.7. So the selling and the hysteria in a way has somewhat dissipated right now. So anyway, let's have a look at these markets. Quiet day really on the data front today. But the week really picking up from tomorrow. Quite a lot of UK data out and the usual menu out of the US for the rest of the week with a couple of quiet pockets in there. But yeah, let's have a look at what's going on. So we'll get rid of these European markets right now. We'll get the Nasdaq up here, and so you see lovely touch into the Nasdaq 14045s. Quite the nice bit of action on the downside there today already seen. So um, you know some good opportunities to kind of get a little bit of mispricing across all of these markets. So let's see if we can manage to hold up on these lows for the rest of the session. So let's see what can we look at here. Nasdaq 1405s even. Let's just pull up that one. So this is the low or the high, sorry, multiple highs here from April 2021. So this was what, like the 16th, 20th, 29th. It's all there. Quite a nice little shelf for this market to pull back to. We had flushed down through here in what was January. Now we've been back up to the 200 EMA and holy resistance here last Thursday, Friday, and then Monday today. So, can this market hold up right now over the Ukrainian Russian fears? Rate hikes, all sorts of stuff going on here. Really, we're going to let the VIX be our guide, and we're going to be tracking that live in the Discord room today. So, do stay tuned for that one, guys in the room. And I would highly recommend getting up your VIX chart and doing some long time frame analysis on that. I think we could get a little bit of a bounce here as we drift into the US session now. Set to come out at 2:30 today. So, I think we can drift back up. Of course, the massive gap down on the NASDAQ here, massive gap down, reopening around 14,250s even. I think we have another gap above that just technically has not closed on the NASDAQ. So, does the market want to rally back up and wipe out both of these gaps this week? I don't think we have the environment for that, to be honest. I mean, don't mean to be a bear here by any means. I just don't see that happening technically with the level of risk that we have in the marketplace right now. Here's SPOOs on the weekly bars. So you can see we've really pulled back to this little ledge here, the 12th of July, the high of the week of the 12th of July, and was a little bit of a line in the sand. So just coming in with a little bit of support, 43.69s right now, trading on the SPOOs. So let's leave that one there where it is. I think any further downside, you're going to see these levels getting wiped out. I don't really want to be crystal balling which one of these levels is gonna be holding up. That's not really what I'm trying to do. It's more just making you aware of the significant levels that will come into play and would be good for risking off of. Further downside, I think let's wait and see. Let's wait and see. I'm in a bit of a mixed mind about it all right now, but certainly skewed to the downside. We're seriously down off of the all-time highs right now. And the Dow, just going to see if we can see anything a little clearer on the Dow. Well, there you go. We had that short opportunity on the top of the trend there last week. Back down, movement done, and into the 200 EMA. Daily bars is what you're looking at here. Can we find the support on the 200 and then, push back up into about the 100 or the 50 into these prices? We could. Is that going to happen? I'm not sure. We've seen this pattern though of selling down in Europe, bid back up in the US session. And definitely one statistic that jumps out at me is that the largest moves in these US equities have actually been, whether it's the upside or the downside, they have actually been in the European section. So, that's why a lot of the US traders are quite jealous of European traders, and that we kind of get to straddle both sessions in a way. But yeah, how does that feed into how are we going to make money today? Well, it doesn't really. It doesn't. All we're doing is observing that we've had our European sell down. Are we then set to get the US buy up again? And this structure is really starting to get disrespected now. So for me, looking on the weekly bars, we could easily trade back down to the 50 weekly exponential moving average here, 33,938 for support. Okay, so that's big analysis there. Some big movements and big levels, and certainly there's a line in the sand in the Dow just starting to trade through now down here. So really 33 800s we'll call it, set to trade on the downside. Nat gas, you can't really look away from nat gas at the moment. This is really my one risk barometer for the Ukrainian situation. When this is all getting sort of priced in, and the second and third order consequence of an invasion would be sanctions on, the first order consequence of an invasion would be the US to put sanctions on Putin, and then the third order consequence, or second order consequence, one is they invade, and then you have a consequence to that, which is number one, the US puts sanctions on Putin, and then second order consequences, Putin tightens up his supply of gas into Europe. But then number three consequences, well, the US just go, great, we're going to sell some gas to Europe. So it's kind of like Europe is a bit of, the beaten up kid in the divorce settlement here, in that it's a win-win for Russia, it's a win-win for the US, and it's a bit of a zero-sum game for Europe right now. So nat gas, this is kind of why this is a proxy for my risk. This is sort of my general VIX right now for this situation. I think the risk is going to get priced into nat gas, seeming as the rhetoric is getting pushed up over the political situation right now. And with that, I think the price in nat gas is going to lift as well. So we've pulled down 3 spot 897s, finding support. Doji there on Friday. We're gap up now on this market. We're into that August high from, I think it was 2014, 2020 August spike high. So I easily think we can start to get back on up into like 4.5 here on Henry Hub. But it's just kind of, how do you get into that trade? So I'll take my mug off the screen here, and you can see this nat gas chart. How do we get in that trade? Can't really jump in at market long. You're going to be adopting a huge amount of risk there. It's a very big risk profile if you're doing that. And that's not really how you should be trading, in my estimation. But this is not financial advice or investment advice. So, you know, yeah, I like the longs in that gas. That's the short and sweet of it, basically. And I'm risking off of these levels and the gap there. I am aware of that gap. Is it going to fill? I don't see any impetus for that to happen right now. And then, of course, oil. Well, I'll cover oil and then the Dixie. So oil here, we're up. What are we? Were we 94 spot 94s on the top of this market today? So I think a healthy little bit of pulling back is due here onto around the S1 9106, and then sort of a tag and go strategy is what I'm looking at to play there on the 91s level. So more retracement down, and then just look for that weakness on the sell side, and then try and lift out of here. So that's really the only trade I'm looking at on oil. Not interested in the shorts here. I think you know for me, when I think about trying to short this thing right now, it just brings up memories of getting run over, and you kind of want to be moving with the ocean here, really. So another thing to note is the EIA had a report out over the weekend. It's in Bloomberg. I've tweeted about it. It's on my Twitter feed. They discovered that they had been miscounting demand by by 2.9 billion barrels. That's twice the strategic petroleum reserve size in the US. So this is a huge amount of oil was not reported on the demand side from the IEA for the last 15 years. So if you throw that into the picture that we have in the tight supply picture that we have now for oil, that this just screams to me like, yeah, easily trade 107. You know, Daniel Jurgen's price, IHS Market's price for oil, that they see as the only target really at the moment. You know, 107 and above really. I mean, we've gotten, you know, an uplift of about 67% year on year of drillers back in the Permian and the Bakken Basin in Texas. Um, but you know, I think we need more. You know, and of course, that's, you know, it's strange that Biden is not trying to stimulate more of these shale drillers and frackers to get back to work in West Texas, because really that's in a way that's you know, the frackers and the shale frackers and the drillers are really the US version of spare capacity, right? Because they can ramp up and get pumping very quickly. But by the same token, those shale rigs, the production output does ramp down quite quickly. So you're not going to be, you know, having stable flow out of those wells for you know, for like 5 years projection. You know, you really would be looking at like well, it's very ad hoc and subjective, but really on par, most of those rails have a hot sort of year to 2 years of flow, and then they sort of get sunset and ramped down or have to be reworked. But the point is, the greater picture is that the US really should be looking at them as their spare capacity rather than, you know, strategic releases from the petroleum fund, for example. So either which way, Joe, poor old Joe, I just don't think he's altogether with it in his golden years right now. I think he needs to retire, come back to Ireland, and just, you know, tell some war stories at the bar. That's my thought on it. But Joe, if you're out there, we love you, man. But maybe it's time. All right, you see the Bund now also breaking free. Been on this one, targeting 167.47. It's just kind of a slow way to play this risk environment. And then, of course, the main show, the biggie, right? The biggie for trading risk and a barometer for risk is, of course, the Dixie. All right, this is the Dixie on the weekly bar chart. So this is kind of all time, well, not all time, but back to 2011 on the left of your charts here. So you can see that, you know, we're finding the supports really generally on this uptrend, which is in play since well, back in when is this? Back in 2011, November 2011, and the March 2014. And really, we've been tracking this for a couple of years right now as a sort of a line in the sand for the market. Either which way, I think Dixie for me, target 97.69, flirting with it about, you know, start of January there, or sorry, end of January, flirting with that level as a target, not getting there, big unwind, and of course then back up we go. In my estimation, we're heading back there now. So, you know, how do you get in on that trade? Well, you got to wait for a couple of pullbacks on the Dixie. You're getting a little bit one now from the highs that we saw this morning on that Dixie. So, just dissipating a little bit of risk as we look towards the US session now. So, listen, that's it from me for today. Do keep looking at nat gas. If you are fond of trading nat gas, I think, you know, putting some focus into that would be really prudent this week. Um, I'm looking at the longs. I know some of the guys in the room here are looking at the longs. But listen, have a great session. Please do click to like and subscribe, and I'll talk to you as the week goes through. All right.